morning. Welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Menaka Doshi.
And you're watching Indian Open, and I'm Shah. Good morning, Menaka. Good morning, viewers. Seems to be a packed day, and the market seem to be okay with the decision by the Fed and the commentary thereof, Menaka.
Yeah, well, I think the U.S. markets were roiled a little bit yesterday. The big impact we saw play out was on the dollar. So let's get straight to the headlines this morning. The first one, the U.S. Federal Reserve increases the benchmark lending rate by 1/4 point and forecasts a steeper path in 2019 and 2020, but sticks to 3 rate hikes this year. The Chinese central bank has also hiked short-term borrowing rates. It says the move will help limit irrational financing. U.S. President Donald Trump may impose fresh sanctions on more than 100 Chinese products as early as today. And Dalmia Bharat files an affidavit in the NCLT accusing Ultratech of malified conduct and intent to cause obstacles in the Binani cement resolution process. It's a shot in the arm for Sun Pharma after the US FDA clears a specialty drug which has a market size of $6 billion in the US. Let's get straight on with the Fed news. On expected lines, 25 basis points, stuck to the script when it came to 3 hikes this year. Did not commit to 4 in any fashion. Said rates would be close to 2.9% next year, 3.4% into 2020. But the dollar moved considerably, not just on, I think what was a less than hawkish sort of commentary by Jerome Powell, but also by all this trade talk that's going on in the US. Right?
Yeah, and apparently a very short press conference as well compared to what his predecessors have done.
It's the first one. Cut him some slack. Come on.
Yeah, no, completely. So stuck to script. I think I was looking at the Bloomberg report as well, and it seemed like he's saying that he will stick to data points as well. But yeah, that's the news, really. A unanimous vote. Jerome Powell, who was chairing that FOMC committee meeting, also projected steeper rate hikes, as Menaka said, in 2019 and 2020. But again, as per expected lines, but as the US economy improves, policy makers said they will stick to 3 increases for this year. Bloomberg's Kathleen Hayes reports.
This Fed decision had something in it for just about everybody, because they did raise the key rate by 1/4 point to 1.5%. That was fully expected, and the question was 3 rate hikes, that is, in 2018 or 4. And in fact, they did leave the rate hike consensus, the number of dots, indicating 3 hikes this year. But for 2019, they moved the consensus up to 3. For 2020, it's also up to 3. So there's considerably more rate hikes over the next couple of years than people were looking for. Now, let's take a look at the dots themselves. Again, the individual forecast from each Fed official based on their view of the economy and where rates should be as a result. What you now see at the far left is the view for 2018, which has 6 at 3 and 6 at 4, right? And it's a very, very close call, because there's still 2 people who think, no, we're not going to get even 3 hikes, and there's 1 person who is looking for even more than 4. I guess that would be 5, wouldn't it? But you can see if one of those dots from the bottom had moved up, or one of those, a couple more, you would have had this consensus for 4. So maybe that's why, even though they didn't move to 4, it does give people the sense that there's definitely a hawkish tilt here, and that the door is wide open for 4 rate hikes, depending on the data. Our Bloomberg economics team saying that they still are betting on 3 rate hikes, but they think this decision kind of satisfied their hawkish urges, but gives them a chance to wait and see how things turn out.
All right, that's Bloomberg's Kathleen Hayes. Now, Powell sounded optimistic about the economic outlook for the United States, adding that the uptick in the jobs market is further validation of an uptick in the economy. Here's what he had to say.
Indeed, the economic outlook has strengthened in recent months. Several factors are supporting the outlook. Fiscal policy has become more stimulative. Ongoing job gains are boosting incomes and confidence. Foreign growth is on a firm trajectory, and overall financial conditions remain accommodative. Job gains averaged 240,000 per month over the past 3 months, well above the pace needed in the longer run to absorb new entrants into the labor force. The unemployment rate remained low in February at 4.1%, while the labor force participation rate moved higher. Over the past 4 years, the participation rate has remained roughly unchanged. That's a sign of improvement, given that the aging of our population is putting downward pressure on the participation rate, and we expect that the job market will remain strong.
Sounded to me, and from what I read, that he will be data dependent.
Well, I think that was the comment yesterday. Somebody said he's not a hawk, he's not a dove, he's data dependent. And I think that's become increasingly the position for all Fed chiefs or all central bank chiefs everywhere in the world, given how difficult it has been to read medium to longer term trends in economies everywhere, right?
Yeah.
I think a couple of things we should point out at this point in time was how the dollar reacted to this. So I think we can take a look at that, and if we can bring up that rate, I think gold also reacted on the back of a weaker dollar. And the dollar sold off mostly on, you know, a little bit of expert commentary on the fact that this was not as hawkish as expected. Maybe the market was sort of setting itself up for the fact that there will be some indication in the commentary that we will in fact see 4 rate hikes this year and not 3. But let's not forget that the dot plot does show that there will be more rate hikes next year and the year after that than anticipated earlier on. We've got an expert voice joining us this morning, Richard Gibbs, principal at Plantagenet Investments. Richard, good morning. You know, what did you make of the Fed commentary, and also more importantly, how the dollar reacted to things?
Look, I think the Fed commentary was consistent with a more rapid normalisation process, which most people were anticipating in the markets. I think the interesting thing is the forecasts, the economic forecasts that we've had revisions for, where we've had the Fed revise up their average expected growth rate to 2.7%. Yet if you look at the inflation side is expected over a multi-year period to continue to undershoot their price stability target of 2%. And I think that gives you an indication of the reaction we saw on the exchange rate side, but more importantly on the long bond side in terms of bond yields.
What do you expect will be the scenario here onwards in terms of rate hikes? The markets seem to have gone into the announcement expecting maybe some indication that there could be 4 this year, but they've stuck to script. They've said there will be 3. The expectation still continues that there could be 4 this year, and of course the dot plot has moved towards, you know, maybe more rate hikes than anticipated in 2019 and then in 2020. So is this going to be as gradual a path as everybody had anticipated? Do you expect any volatility in being able to sort of read what goes on with the rate markets?
I think there is going to be volatility, and I think the reason being is that most of us with a memory of 1994, when Alan Greenspan was the chairman of the Fed, of course, was playing catch-up, remember how the yield curve, deteriorated enormously and responded very badly to those rate hikes because there was an expectation that the Fed was catching up to accelerating inflation pressures. That's different this time around, but the conundrum for the market, of course, is on the unemployment side, where the Fed seems quite willing to allow that drag from the output gap that occurred after the GFC to be wound back, and really is looking like they're going to be content with an unemployment rate falling as low as 3.5% in the US. And that's going to be I think the cause of volatility, particularly when the bond market then looks at its risks and goes, well, we're not seeing any appreciable rise in or acceleration in inflation pressures. So that then leaves you with an issue of, well, is there any willingness or propensity to see a rise in the credit premium for the long bonds, and that's unlikely as well. So we've really got, I suppose, an uncharted situation. We can't run the 1994 situation, which is what the markets are wary of, because that was a very damaging time, obviously, for bond and equity markets. So I think that's what's going to produce the volatility, trying to second-guess the Fed and work out how consistent their communication is, their signalling, with what we're seeing with the aggregate variables in the economy.
Richard, if indeed the Fed is not going to be disruptive, and there were enough comments made to show that they are going to be data dependent, then does the Fed become, as somebody said yesterday, a sideshow, since they are only going to be playing catch up? And would the markets, which is the bond markets or the dollar IBOR and some of the others, provide or prove to be the lead indicators of what will impact the equity markets and the bond markets over the course of the year?
Well, I think there's some element of truth in that, but I think for Jerome Powell, the new chairman of the Fed, the Board of Governors, I think wants to be seen as proactive rather than reactive, and you're suggesting the risk is they become captive and reactive. That was very much the situation in 1994, and that is the template that everyone goes back to, or the paradigm that everyone goes back to with that experience in the markets, because that was destructive for all asset markets. But we don't have the precursor to that this time around, because we don't have exhilarating inflation pressures that are there and evident or being measured at this point in time. We still have an undershoot. So that, I think, is going to be the issue. And then the problem for the Fed, too, is you don't want to be a captive of the data purely and simply, because otherwise you're on a month-to-month roller coaster. As much as people say, well, we look through the month-to-month volatility in data, markets don't. And so I think the Fed is going to want to try and create a narrative that actually is forward-looking but does not really hang everything on one particular variable, and because that will be problematic.
Richard, one final question from me, and that is, are you looking at short-term rates more closely than you are at long-term, at least in the U.S.? The 2-year has gotten quite a bit of attention over the last few weeks, and it does seem to be steepening the yield curve a little bit. So a question on that, and also your view on where the dollar goes from here.
Yes, I am, because if we get a sharply inverted yield curve, that doesn't necessarily augur well for the near-term outlook for growth, of course, because it shows that you're getting an appreciable tightening. But what we do know about the U.S. economy in particular is that it is much more financially susceptible and sensitive to long-term interest rates than short-term interest rates. Short-term interest rates will come into play in a major way, of course, with the exchange rates. And with shorter-term capital flows, and that's the importance for emerging markets, of course, like India, what that means for those the stability or lack of stability of those capital flows.
And the dollar?
The dollar, I think, really will continue to track upwards. I think there'll continue to be pressure there. Interestingly, though, we've now got, of course, a major political issue there with the tariffs and the move back towards a more protectionist approach by the Trump administration, which was promised, of course, in the campaign. And if history is any guide, that is normally an undermining factor for the value of an exchange rate.
All right, Richard, thank you so much for joining us this morning and sharing your thoughts on what went on last night, Jerome Powell's first FOMC meet. Let's move on now from news of those markets. Though actually, before we do move on, to pharmaceutical news, Neeraj, a quick sort of take on, how you expect Indian markets to read this, if it is that important at all. Most parts of it played to script, so.
Yeah, and I think the bounce that we've seen in the last couple of days, a lot of people have been calling it a dead cat bounce and an immediate bounce which will get sold into, might get supported a little bit by virtue of what the other asset classes and other Asian markets have done today. But it would be very, very difficult to presume that this will happen. I mean, maybe the markets are waiting for this event to go by and then resume what is a normal trajectory, and the normal trajectory according to almost all people, is that there will be some bit of a downward bias to our markets until we hit earnings, and if earnings give that bit of a momentum, positive momentum. So this is the third day that we'll have a start in the green, which is actually great news. The question mark only remains as to how long does this bounce continue before people start pulling back the positions as well. Remember, the options data have indicated we are firmly positioned to be in the range of a broad range of 10,500 to 10,000, yes. But at 10,000 remains the pivot around which most people are betting that the market could find support. Conversely, also the levels at which the market would drift down to closer to expiry. Remember, expiry is earlier this week. Next week we have it on Wednesday instead of a Thursday. Right. So about 4 days to expiry. You would probably presume that this bounce that is up would probably get sold pretty soon.
All right, a quick check on markets there. Now let's get on to the regulatory news in the pharmaceutical space. After getting weighed down by regulatory woes for an extended period of time, there is some good news for Sun Pharmaceuticals. The U.S. drug regulator has approved Sun Pharma's filing for a psoriasis drug after spending years and big money on its development. The drug approval comes as a much-awaited boost. Dashan standing by with all the details of exactly how this will benefit Sun Pharma Illuma. Is that how it's said?
Yeah, Iluma is the brand name. It's known as Tildra, so that's what the general public knows that. So just the news first, and then we'll get to what it means for Sun Pharma. So finally, the US FDA has approved Tildra for Sun Pharma, so that's a positive. And the drug is used to treat psoriasis. So that's the broad news that has happened. Now, in terms of the entire timeline. So what happened in September 2014? Sun Pharma bought this drug from Merck. They spent $80 million, and Merck had already conducted phase 1 and phase 2 trials. Now, what happened in May 2016? Sun Pharma announced positive results for phase 3 because their phase 1 and 2 was done by Merck. Then in October 2016, they presented the study in Vienna in front of the European Academy of Dermatology, and that was something that was extremely positive. Finally, if you're looking at it, almost Sun has spent $320 million on the purchase and development of this drug. $80 million went upfront to Merck. The balance $250 million was spent in R&D by Sun Pharma. And finally, yesterday, Sun Pharma gets the US FDA nod for the drug, which is considered positive. Now, let's take a look at what this market is and what this partnership is. Partnership with Merck. So Merck will manufacture the drug and Sun Pharma will market. And because of this, Sun Pharma, apart from the upfront payment that they have done, they will pay milestones and royalty to Merck going ahead when the sales do happen. As far as this entire market is concerned, it's a big market. It's a $6 billion market. It's a crowded market, no doubt, but the market is growing in single digit. But remember, a single digit is on a $6 billion base. So the growth potential is significantly higher. Now, what are analysts saying? What could potentially happen? They believe a $250 to $350 million annual revenue from year 5 is something that they are factoring in, and revenues can be higher if the growth is much higher than the single digit that the market is predicting at this point of time. It's a high margin drug. Margins will be to the tune of 80 to 85%, but overall, because it's a crowded drug, analysts see the market share for Sun Pharma less than 5%. As far as what works for Sun Pharma here, first of all is the fact that the low frequency dosing is a big advantage that they have, because in efficacy it does not rate among the top there. Secondly, the growth in the specialty portfolio will definitely come in for Sun Pharma because generics is having a problem. So the specialty drugs will stem the decline in the generics market that it has been facing. Apart from it, it's a branded drug with high margins, so it's not a generic, so that is something that is positive. And finally, it's a large market with significant amount of growth potential that could benefit Sun Pharma going ahead. Now, what doesn't work in favor of Sun Pharma? First of all, it's already late in a crowded market. Some of the other competitors have at least a 2-year advantage on the drug. They've already come in much before that. They need attractive pricing to gain market share because the efficacy is not extremely high. So they're betting on the dosage. So it's not a superior product in terms of efficacy. That is where Sun Pharma will not get. And finally, they will need 3 to 4 years to ramp up the drug. So nevertheless, so finally, if you put this in a nutshell, it's positive for Sun Pharma. Definitely the share will open, the street will like it. But remember, the peak revenues will come in after 5 years because they will need 3 to 4 years to ramp up. So definitely whether the rally will sustain, most of the analysts I spoke to indicate that, this could add anywhere between 20 to 25 rupees per share on Sun Pharma. And that's some of them do also mention that it's already factored into the price. But nevertheless, it's positive news for Sun Pharma after years and years of not getting anything there.
Darshan, I had one question. Wouldn't the peak sales estimates be a fairly dynamic number? Because the market, as I read overnight, is a fairly growing market. Psoriasis is now being promoted for aggressive treatment as well. So the peak sales over 5 years or 10 years is a fairly dynamic number, right? So
I'll tell you here. See, there are already drugs that are there. This is the third version. There was IL-12, there was IL-27, this is IL-23, which is the most superior drug. It's a $6 billion, but it's growing at 1%. But there are already 9 players there. So what is being factored is now Sun Pharma needs that time to go in. So they will have to go to doctors, they will have to get the prescription done, everything. So that will take 3-4 years to ramp up because it's not a superior product. It's a low dosage product which will benefit them not as much as it could have been a superior product. So the peak sales pretty much will come in the 4th or 5th year, will be anywhere between 300 to $500 billion. That's the broad range. If the market grows higher, it could grow higher, but there'll be more competition also that will come in. So on a average base, anywhere between 300 to $400 million on the 5th year is something that the street broadly is anticipating.
But it'll start getting priced in right now.
It is. Quite a few of them said that it's already priced in.
Already priced in.
Some of them say it's already priced in. Some say that, it could add in another 15 to 20 rupees. So that's what pretty much a gap up is something that you can anticipate on Sun Pharma.
All right. That's the Sun Pharma story. Some good news, at least in the pharma space. It's been a while. Most times Darshan is here right up in the morning to tell us some FDA visit has gone wrong. Right? Thanks very much for that, Darshan.
Well, it's very interesting that the market started maybe pricing in or preempting this, because remember yesterday we were talking about how pharma stocks started showing a bit of an uptick from July 2014 lows. Sun Pharma was the principal gainer day before yesterday, up 5%, didn't do too much yesterday. So let's wait and watch if there's a further reaction today or no. But the other interesting story on First Word today is toying around with valuations. Now, despite the correction witnessed over the past month and a half or maybe 2 months, a large number of Indian equities still trade at a premium, and a substantial premium, to their long-term average valuations, not prices, but valuations. And a large share of the expensive stocks are from the financial sector. I'm not surprised that private financials, I believe, would be topping the list. So let's first get a snapshot and we'll dwell into what would this mean. Jayesh is standing here with a snapshot of what the valuations are. Jayesh, let's not be predictive about whether there is still correction or no, but let's just give data about what is it that some of the expensive stocks are trading at compared to their 5-year or 10-year average multiples.
Yes, Neeraj. So let's point out the data. In fact, the number of stocks or the percentage of stocks in the Nifty which are currently trading at premium stands at 58%. So what we did was, divide it into two segments, ex-financials and the manufacturing stocks. So if you look at the manufacturing space, now that's the current PE that you have versus the 5-year PE, average PE. So, and you can see the premium over there as well that it is trading at. So at the top of the list, we have Bharti Airtel, which trades at about 160% over where the 5-year average PE was, followed by Hindustan Unilever and Reliance Industries. Now they have higher weightage on the Nifty and they trade at substantial premium, about 40 to 46% as well. Now, if you look at the other stocks that are there in this list, is Vedanta and Hindalco Industries, which have a premium of about 36 to 38% on the Nifty. Let's look at the other set of stocks. So these are the top 10 stocks which are trading at significant premium. We have Cipla and Maruti, which has actually seen a significant correction, and yet it trades at about 25% premium to its 5-year average. Followed by some of the names like Coal India, Ultratech, and NTPC also trade at a significant premium. So this is as far as the manufacturing stocks are concerned. Let's look at how the financials have actually fared. So for financials, we have looked at the key parameter price to book. Now you can see that there are 6 stocks in this list which are trading at higher valuation as compared to their 5-year average. So you have Bajaj Finance, Indiabulls Housing, HDFC and IndusInd Bank. These are the interesting names. So they are also trading at a significant premium, followed by HDFC Bank and Yes Bank as well. Now, how does all of this stack up in the space of where the Nifty weightage is? So if you look at the weightage of the Nifty, currently the stocks that are trading at premium, those constitute about nearly 68% of the Nifty weightage. The stocks that are over 50% premium, that is only about 4.6%. But the real concern would come in at the 30 to 50% and the 10 to 30% premium. Now look at the 10 to 30% premium, that constitutes nearly 46% of the Nifty weightage, and you have 0 to 5% premium, which is just about 4%.
So you're saying that the data shows that 46% of Nifty stocks are trading at between 10 to 30% premium to their 5-year average valuation?
Not 46% of the stocks, 46% weight on the Nifty.
46% weight on the Nifty.
The number of stocks which are there, which have a premium of about 10 to 30%,
amount for 46%
they constitute
of the
46% weight on the Nifty.
Okay, all right, interesting. Is there a conclusion to draw from this, is that we're still a fairly pricey market in that sense?
Yeah, so the reason why we did this exercise, Meenka, was one, to point out the numbers, and then to take stock of what stocks are really vulnerable out of these weightages as well, right? So between me and Jayesh, we figured out 4 or 5 names. So you would presume that if you look at the list of stocks which are trading at a substantial premium, Reliance would pretty much be unaffected. Even with its size that it has, it's now being touted as the growth story in the telecom space. Difficult to assume that people will really say that Reliance is trading at a substantial premium to averages, because the last 5-year and 10-year averages have been low for Reliance Industries, the P multiples. Therefore, these would be considered to be mean valuations. HUL, it's a very strong stock in these uncertain times, and therefore difficult to see, even though it's trading at a substantial premium to long-term averages, that will have a correction all the way down to it being trading at about 40 or 44 times once again, because people like to buy safety, FMCG.
Yeah.
Similar story with the HDFC twins, right? They are always strong stocks, always traded at a premium, and very strong stocks in uncertain times. So the weaker hands, if you will, which could correct, are probably Bajaj Finance. The NBFC story seems to be unraveling a bit. Yes Bank, Indiabulls Housing Finance, again, stocks which perennially have some issues surrounding them, so they could be there. And the commodity stories, Vedanta and Hindalco fall in that bracket of the 30 to 50% premium. If indeed the commodity story starts coming off a bit, then you could see those valuation multiples coming off. But otherwise, for a clutch of others, even though they are at a premium, it doesn't necessarily mean that they'll revert to the means, because the means for certain companies have been low any which way.
You know, most surprising though to me in all of that data was Bharti Airtel topping the list, because, you know, given the sort of the how does one put it, the bloodbath we've seen take place, and I hate using that word, but the disruption we've seen take place in the telecom industry, you know, I'm surprised that that stock still trades at a, what, 160% premium to its 5-year average PE.
Yeah, I think it's probably a factor of it moving up from that 300 levels all the way to 500 and then seeing that bit of a bloodbath. But yeah, that's an astounding number, but maybe people won't look at the PE multiples for Bharti Airtel.
All right. Great work, Jayesh. Thanks very much for joining us with that. So that's a quick look at the stocks that are currently trading at substantially higher than their 5-year average PEs.
Well, that's all.
Wrapping it up?
Yeah, that's all we have on first word today. Full tilt towards the day's trade on the other side. And remember, market conversation coming in with one of the largest asset management companies, Harsha Upadhyaya of Kotak Mahindra AMC, would be joining us to talk about his thoughts on the Fed, on market valuations, and lots more.
आइसक्रीम ये है डबल आनंद। पहला आनंद पॉलिसी टर्म के अंत पर मैच्योरिटी क्लेम का पूरा भुगतान, और दूसरा आपके अपनों के लिए लाइफ कवर की पूरी रकम बिना किसी प्रीमियम के। LIC न्यू जीवन आनंद, आनंद ही आनंद।
सॉरी, आई एम लेट। क्या हुआ?
कुछ नहीं यार, जस्ट वर्किंग ऑन माई एक्सपेंशन प्लान।
फंडिंग का चक्कर।
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख। ला।
अरे।
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल।
हाँ।
NSE Emerge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent. New fashion wear for men.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
A show and a series where we speak to some of the best investing minds in the Indian markets and try and figure out how is it that they generate alpha for their investors. And in the case of today's guest, needs no introduction, Mr. Vijay Kedia joins in right now on the show.
Only one mantra in stock market is to make money in market is to sit for long term only. You cannot make money unless you have patience to hold for your stock for 10 years or 15 years or 20 years. You certainly cannot make money in stock market. Majority of my portfolio, if you that would be not more than 10 shares. To get a cleaner management and a management with a good track record, so I have to find only 10 shares.
Welcome back. You're watching Indian Open on Bloomberg Quint. Let's see how the Asian markets are faring at this point of time. Most of the Asian markets have actually come off the day's high. The Hong Kong markets have slipped into the red. The Nikkei, which is trading up over 1%, has now cooled off to just a gain of 0.4%. And the SGX Nifty has come off significantly from highs of the day. It was trading up almost 50 points. It seems that, the higher end of the market is not being able to sustain at this level. So there is definitely weakness. And yesterday also we came off significantly from the highs of the day. From 100-point gain, we were just up 30 points. But what are the FNOQs indicating? And Navneet, it seems that 10,200 is the pivotal point. Any move on either side will mean a massive move on either side. Is that what the FNOQ is indicating? And what's happening with the Nifty and Bank Nifty as such?
Good morning, Darshan. Well, it's Thursday, so we are in for more volatility. Today is the day when the Bank Nifty weekly options expire. And talking about Nifty, it's finding a bit difficult to hold above the 200-day moving average of about 10,165 thereabouts. And that's what happened, actually. We did cross the mark of 10,200, but we could not close above that. So for Nifty futures, just about flattish, nothing happened. Let's pull up Bank Nifty. That's going to be in focus. Where can the expiry take place? If you look at the options data, it is suggesting that the expiry could be in that range of 24,000 to about 24,500 on the upside. Second straight day of unwinding scene for the Bank Nifty futures, and volatility yesterday gave us a bit of a breather, especially for the bulls, as the India VIX, that was down nearly 3%. Let's just pull up the PCR. A bit of put writing was seen yesterday, as Darshan also indicated. So a slight bit of uptick for Nifty and a slight bit of uptick for Bank Nifty as well. If you look at the options data now, as Darshan was highlighting, this is the strike which is in focus. So yesterday there was a lot of put writing which took place here, but I also want to highlight the 10,000 strike. Open interest was down nearly 13% in yesterday's session. So watch out for that range in today's session as well. And what about the FIs? What did they do? Well, some fresh shots were definitely seen on the index futures. Let's just pull up the options data. Some bit of shots were seen here, but we did see the call long contracts going up. In terms of stock futures,
specific stocks, Navneet, what specific stocks should people watch out for in the session?
Well, Neeraj, yesterday during the show of Countdown, we highlighted Divan Housing, and that's actually come out of the F&O ban. So watch out for this counter again, because it's come out. You could see higher activity now in today's session. Besides that, United Breweries is the other one where we did see some fresh shots coming about. And the other one I will be focusing on that will come up is Balrampur Chini.
Well, interesting moves in Balrampur Chini for sure as well. Navneet, thanks for putting all of that into perspective. So those are some stocks and activities or stocks which were active and you should watch out for in the session today as well from a trade perspective. What about the fundamentals? Parthiv Shah, director at TRACOM Stockbrokers, joins us on the show now as he does every alternate Thursdays. Parthiv, always good having you. Thanks much for taking the time out. What should one do with the commodity stocks currently, Parthiv? I mean, one, that they are active for a lot of other reasons than pure fundamentals, but fundamentally too, with all that's happening across the world, Fed raising rates but on expected lines, but the dollar reaction thereof and the resultant impact on commodities. All this put together, what would you be doing with your investments into both the ferrous and the non-ferrous stocks? Hindalco, Tata Steel, Vedanta, amongst the key ones that I want to know about.
Good morning. Neeraj, I think recent correction in the especially ferrous and non-ferrous stocks to the tune of almost 8 to 10%, I sense it's a good opportunity to enter these stocks. One, I think if we understand the entire metals cycle, I think in the first phase we see a slow and gradual increase in the prices of these commodities, especially because of the demand. And as and when they start generating cash flows, instead of newer capex, they start deleveraging the balance sheet. As we saw in case of Vedanta, last year they decreased their debt by almost 11,000 crore. That's a humongous amount. They are cleaning up their balance sheet, which was an issue. I remember a point in time when Vedanta had hit a loss of almost 60, 70 bucks, and there were talks about the debt getting downgraded, etc. And so was the case with many of the other companies. They talk of steel, aluminum, zinc, lead, all of these commodity plays. But now I think we are seeing a trend that these companies with fantastic realizations, even post the dips in the Chinese markets that we saw in terms of the prices of these commodities, I think still these players are very good cost efficient players. Their cost of production is relatively very low as compared to many countries in the world. So in that case, a play like Vedanta, I still feel I think it has two important major triggers. One, I think oil. Oil is almost touching $70. So the Kane acquisition, which till date, I think many had question mark in terms of what sort of cash flows it can generate, what sort of production targets and exploration capex. All of this, I think, tends to improve with oil moving upwards of $65. So that's a place where I believe Vedanta will have a lot of trigger. Yes, I think there are these talks of the Goa mining ban, but it's minuscule in terms of the overall scheme of things, in terms of the other commodity that Vedanta has. Zinc is extremely stable. They have very low cost producing assets. Lead is stable. Aluminium, I think they've got some recent bauxite mining rights. So I think that will be very helpful for the utilization out there. So I still believe Vedanta, unless and until they make very, very aggressive inorganic moves, I believe Vedanta at an EV EBITDA in terms of the forward valuations at around 6.5 makes very good sense. Talking about a steel play, I still believe, I think JSW Steel, one of the best capital allocators, again, in terms of their sales, they're continuously improving the percentage of the value add component, which helps them to stabilize the margin despite not having their own coking coal and iron ore mines. So again, I think as compared to Tata Steel, the only reason I'm slightly wary about Tata Steel is because of the very heavy inorganic acquisitions that they're talking of. And they also in a capex mode. So I think debt reduction will be a little tricky for Tata Steel. But I think JSW Steel, I believe, makes very good sense. So these two stocks, I think I would stick my neck out and still believe that these dips give very good opportunity for investors having at least 3-year horizon, which is quite predictable in a commodity upcycle to be invested in.
Okay, hold on, Parthiv. We'll definitely get back to you. Our research team is now waiting in telling you what are the important stocks that you need to watch out for. There's an interesting note of HSBC on ICICI Lombard. They see a 16% downside. And I think the traders' favorite of recent has been Jubilant Foodworks. Some news coming in after market hours yesterday in terms of their value of proposition that they've done. But let's get first to Shraddha. What are the important news that you need to watch out for today?
IDFC, I think that could react positively. This is on the back of a Times of India report which says that IDFC is looking to exit the asset management business and they're asking for a valuation of 4,000 crores, which is about 6% of its AUM. So watch out for that name. Zensar Technologies, they've acquired Synosure India for 13 crores and Synosure US for $31 million. That's 200 crores or so. In addition to performance-based deferred payments, you have Dilip Bilcon, which has been declared as the lowest bidder in a new EPC project worth 870 crores in UP. Clarification coming in from Axis Bank on the TD-SAT order requiring bank guarantee to be returned. They've said that they stand committed to honor their commitments. They've also clarified their exposure, non-fund based exposure to the telecom sector, which Axis Bank said stands at 9,200 crores, and that they have no exposure to Aircel. GE Power has won orders worth 230 crores. So you could see a positive reaction there. And Jindal Drilling, which has settled an arbitration award for an amount of $31 million for $9 million. You could see some positive reaction there also.
Okay, certainly we'll watch out for all those stocks in trade. But Nikki, why is HSBC so bearish on ICICI Lombard?
So it has reiterated the reduced rating that it has with a potential target of 610, which indicates a downside of nearly 17%. It says that the market, it had a survey around the market after its initiation report and figured out the market seems to be receptive to the focus of reserving issues. Also, it says that the concept of under-reserving in motor third-party liability is also a key risk to the company. Increasing losses in crop insurance and fragmentation in motor market also seems to be negative. However, the passage of a motor vehicle bill, which could be a big upside risk for the company, has not been factored in the estimates, and this could, if passed, could improve the third-party motor profitability and better than expected loss ratios.
Okay, so we'll watch out for ICICI Lombard. And Sameet, are pizza expected to be cheaper now?
Yes, it is now. The Jubilant Foodworks, which has the franchisee of Domino's, has introduced regular pizzas in their everyday value offer. The two of the regular size pizzas will be available at a starting price point of 99 rupees, thereby reducing the prices by around 40% to the regular menu prices. Now, if you see earlier, the company had done this on the medium-sized pizzas, which has accelerated the company's same-store sales growth in the last quarter. Now, what are the brokerages saying on this? Well, Macquarie and Goldman Sachs both are saying that increasing affordability will drive the same-store sales growth for the company going forward. Along with this, Goldman Sachs is saying that lower price point will positively impact the pizza volumes for the company, while Macquarie says that lower price point will definitely have some impact on the gross margins of the company, but it won't impact the EBITDA margins of the company, given the higher operating leverage that the company will get because of higher same-store sales growth.
Okay, are you buying pizza for everyone today?
Yeah,
Is that
definitely.
cheaper?
Guys, that was the question that I wanted to ask as well.
Oh, sorry,
Since
I didn't
all
know.
of you are out there, Darshan, Shraddha, Sameet and Nikki, are we going to be having a pizza party in office today?
We should.
I think we should. Sameet said he's definitely ordering one of them.
Okay.
But I think let's stick with Jubilant Foodworks because it's very interesting. If we have some charts for you, Neeraj, if you can join me, and you know it's very interesting. It's been a technical trader's delight for the last few days. This is the chart of 1 year for Jubilant Foodworks. It's been a big outperformer. Look at where it has moved. Now, if you see this blue line, if you see the pink line, that is the 50 DMA, and it has always managed to bounce back from that level. So it has never broken from the time the trend started. It's never managed to broken, and it's comprehensively stayed above the other two DMAs. So that's something that the counter is moving, and it's again inching back to its fresh lifetime high. So technically, I think this looks very, very strong. Even if you're looking at some of, I think it's some close to 2500 is the all-time high.
Yeah, 2330. I think that's the number that is coming on the
okay, so that's
on 23rd Jan.
Yeah, so basically it's inching towards the all-time high. The other thing that also wanted to point out is that valuations are not that expensive, because if you're looking at it, valuations this year is 75 times, but if you look at valuations next year is 50 times, and FY20 is 40 times. So on an FMCG, on a consumer growth story, the growth is coming in, and that is what a lot of analysts do talk about recently, that when growth is there, valuations are something that, and it's not for a consumer stock, not the most expensive. You've seen companies with more than 100 times that are growing. So Jubilant Foodworks definitely, and this pizza deal that they've come out with, I was reading about it, and it looks extremely positive, given the fact that prices have come down by 40% on 2 pizzas if you order it. So they're playing on the volume growth. So last time it worked for the medium-sized pizza. Whether it will work for the regular-sized pizza, it's interesting. But I think this is the stock that we should follow in trade.
Yeah, well, the past few quarters, the same-store sales growth as well, Darshan, has been testimony to the fact that the new management somehow has really, maybe it's the forces of nature at work, but ever since the new management has come in, the same-store sales growth numbers also picked up.
And see, last quarter was a base quarter of demonetization. Even this quarter, if you see the fourth quarter, the base effect definitely will be there. So they will again probably cross double-digit SSSG. So Jubilant Food was the first one. Secondly, I wanted to talk about an interesting thing that I saw was the Tata Motors DVR. And look at the spread. The spread in October, November was 203 between the two counters, and it's now at 145. It's the lowest level since, I don't know, since March 2017 is what I can see.
Last 1 year at least.
Yeah, at least last 1 year. So gives an indication that the trend is indicating that the Tata Motors DVR probably it's starting to converge, and the Tata Motors DVR has a high probability that it will look at the trend that's happening, and the Tata Motors DVR probably will outperform Tata Motors going ahead. So that's something interesting that I spotted on the Bloomberg terminal, that the spread has gone from 203 all the way to 150, and it's happening slowly and steadily. So people don't realize this, but the trend is big, from 203 to almost 150. So that's a big spread divergence that's happened. So Tata Motors DVR, I'll definitely watch out for over the next few days.
Let's ask both of these questions to our expert. Parthiv, take your pick. I mean, Jubilant Foodworks and this whole deal that they've struck, or Tata Motors. We can start off with either one. Okay, I'll give you a question. Let's start off with Jubilant Foodworks and this new scheme and the valuations, and put all of that into perspective. Would you be a buyer here?
Firstly, Indra, extremely important. If you guys are ordering the pizzas, please do send some out here in Ahmedabad as well. So, Neeraj, I think, we'll have to understand the reason why there has been change in terms of the SSG. I think I must give credit to the management in terms of their proactiveness. This has happened ever since they've changed their recipe. And I still remember back in my US days, Domino's had a major revamp in terms of the recipe, in terms of the crust, the puree, and all the recipes that they have. They took a lot of customer feedback, and I think this is extremely important for a company to listen to their customers. And Domino's India also did that. Even small things in terms of the advertisement, that they're increasing the size of their toppings, I think does really help the customer recall. And indeed, there has been a huge difference in terms of the taste of the pizzas that they're offering right now versus what was there in the past. Plus, now they're trying to very aggressively aggressively, because in the bad days, I think they did a lot of cost cutting, and now they're going to use that cost cutting to offer these value meals. So I think, as Darshan very nicely explained, I think they are definitely going to maintain the trajectory of the SSG, and I think it's one of our best plays in terms of the consumer spend. So I think they are doing all the right things, hitting the right customer calls, and I think innovation plays a very important role in such companies. And we are seeing the Yums brand, I think Pizza Hut, Papa John's tried here.
Parthiv, so my question is this then, that you are fine paying anywhere between 75 times and 44 times, depending on which year you're looking at in terms of your multiples for Jubilant Foodworks.
Yes, Neeraj, I do, because I still believe it's a huge untapped market. They're growing on their stores, they're maintaining their SSGs, and hopefully they'll even maintain their margins, because I think the gross margins might be affected, but because of the cost cutting, they might be able to maintain their EBITDAs. So I think for such a growth play, I do believe there's a long way to go for these companies to get further re-rated.
Okay. Parthiv, we'll take your address from our guest team as well. The pizza is coming up at your office sometime this afternoon, so remember that. But anyways, we'll talk about Tata Motors in a bit as well, Parthiv. But since we're on the topic of Jubilant Foodworks, it is holding on to those trend lines, and it's about time that we talk about technicals as well. Let's just shift focus for a bit and get in our technical experts on board. It's anyways that time of the show. So Kiran Jadhav, Chairman and Managing Director at Kiran Jadhav and Associates, as well as Sameet Chavan, Chief Analyst for Technicals and Derivatives at Angel Broking, joins us on the show. And some important points to discuss with both of them. Sameet, day before yesterday, identified the pharma uptake very well. Sun Pharma was his top pick day before yesterday, and I think it will give traders some money today as well. But Kiran, I want to start off with Jubilant Foodworks. A very quick thought that before we talk about the market, since we're on the topic of Jubilant Foodworks, how do the charts look here?
Are we talking about Jubilant Foodworks?
Jubilant Foodworks, Kiran.
Yeah, basically, yes, a very good chart with consistent high top, higher bottom. And in the recent past, the rally that we saw from a level of sub 2000 to 2200 as we closed above that level, strong delivery-based buying with strong derivative data makes the stock really good at to be bought at all lower levels. So buy and dip strategy is to be adopted with a positional view. We'll soon be hitting that all-time high of 2300 for sure. The kind of pattern that we saw breakout of the 3-day, 4-day consolidation yesterday is followed with huge delivery volumes, delivery-based buying, and that's the reason why we have a target of over 2300 in the short term. And for this long position to be initiated, we have a nearby stop loss at around 2160. So a good risk to reward ratio from current levels, and we believe that this counter will be a market outperformer from these levels.
Okay, Kiran, any view on the Nifty? The Nifty, SGX Nifty has managed to cool off from levels of a 50-point gain plus to just 10 points now. And yesterday also we saw the Nifty correcting significantly. Is the fear still there in the market that we might even go back to 4 digits?
The kind of chart patterns are quite confusing. Day before yesterday, the kind of rally that we saw at the fag end of the market really gave us a thumbs up that we should move up higher. And that was the first kind of short-term bottoming out pattern that we saw, which ensured that yesterday we moved up higher in the first half. However, the sell-off that we saw in the second half raises a good kind of concern for now. And that's the reason why we'll be stuck in a range, because on the day-end chart patterns, the candlestick pattern has displayed a spinning top kind of candlestick pattern, which is basically neutral. So we'll have a break or make level on the higher side that is around 10,230 levels. Move above that only will confirm the next leg of the rally, which can take the Nifty back to 10,300, 350 kind of levels. However, the support of the descending channel that we are in comes at around the current lows of 10,100, 10,080. So this will be an important support level to be watched out for. So in between, we'll see seesaw activities consistently between these levels of say 10,080 on the lower side and 10,230 on the higher side. Only a breakout.
Sure. Okay, I just think we lost that audio of Kiran Jadhav a bit. But anyways, we got his view on the Nifty. Sameet Chavan with us as well. Sameet, good morning. Great calling on Pharma. But what's the call on the Nifty today?
Hi, morning. See, there are two ways of looking at it. If you have to look at it from this series perspective, then 10,000 remains to be a very strong support if you look at the overall open interest concentration around 10,000 puts. But if we have to look at it from a slightly broader perspective, then we would continue with our cautious stance, and any minor bounce backs would be a good selling opportunity. In our sense now, 10,300, 10,350 has become a very strong hurdle. In case of any relief rallies, you should look for selling opportunity, and will not be surprised to see Nifty entering sub 10,000 levels quite soon. So we would continue with that stance. So in case if Nifty gives a decent bounce back from current level, use this upside to go short on the market, and you would expect, at least in this series, you can expect 10,050, 10,080. But going ahead, if we have to take next 3 weeks time horizon, then we would be seeing Nifty sliding toward 9,800, 9,750 also. So in case of bounce back or some kind of time-wise consolidation, you should look for stock-specific opportunities rather than getting aggressively long into index-specific trades.
Okay, so we'll certainly watch out for, and as we speak, SGX Nifty is almost into the red. But it's time for a special segment called Bloomberg Edge, where Jayesh Khilnani tells us about a pattern that the Bloomberg terminal has thrown up on the stock or a sector. Jayesh, what's on the radar today?
Darshan, before we move to today's stock or pattern, Jubilant Food, that was the stock that we had covered, in fact, on Bloomberg Edge yesterday, and the stock did manage to end up about 4% higher. But coming to today's pattern that we have, so what I've done is I've taken a ratio of the Nifty divided by the Nifty Metal Index, and that's the 1 year chart that you can see of the ratio itself. Currently, the ratio stands at about 2.9, and you can see that in the past also it has faced resistance on around this 2.9 level. What does this mean? That, post the correction, we can see that the Nifty Metal actually rallies more than the Nifty Index. So during September month, the ratio declined from about 2.9 to 2.7, and during this period, we'll see how the returns of the Nifty and the Nifty Metal Index was. But in the month of December also, it declined from about 2.9 right up to around 2.5 levels. Now, if we can see how the Nifty and the Nifty Metal Index also performed during this period, it's very interesting. So currently at about 2.9 levels. Now this was the rally that I was mentioning, or the decline in the ratio, which means that the Nifty Metal Index during this period rose as much as 15%, while the Nifty rose just about 7.5%. So, double the outperformance. The December instance, same thing happened. The Nifty Metal Index, in fact, rallied nearly 20%, while the Nifty Index rallied just about 9 to 10%. So, going forward, if we can see that this ratio declines, then we can expect that the Nifty Metal rally to resume, in fact, and actually outperform the Nifty as well.
Okay, Jayesh, we'll certainly watch out for, and now we know who's ordering the pizza today, because
I should be the one who's getting the pizza.
You claimed credit for identifying it, so I think you deserve to treat everyone for it.
Sure, I'll do that.
Okay, let's move on back to Parthiv's waiting by. Parthiv, the big news that came overnight was Sun Pharma. And the approval that they got for the drug. How do you see this playing out for Sun Pharma?
See, absolutely, Darshan. This is very important, because I think when we talk of these pharma plays, I think we know that there's a lot of price erosion in the generic drugs pipeline. And I think these specialty plays, especially for Sun Pharma, in the last 18 months, this is kind of the third approval. And despite the fact that knowing that there's a lot of competition for this drug, already there are big players in the foray, and I think it will take some time for them to scale up. And they've done a lot of investments in terms of the $80 million royalty that they've paid to Merck, and also almost around $250 million in terms of the research cost. But I think this is very encouraging signs, and goes to show that all these big pharma plays, I think, though in terms of the price movement, it's not been great, but I think because they have this specialty pipeline going ahead, I think there'll be a transition in terms of the revenue getting a larger revenue from this specialty pipeline play, which will come at a relatively higher margins vis-a-vis their current pipeline, which is definitely very encouraging. So I believe these news should be positive for Sun Pharma, and it'll be very important to see what pie of the market share they're able to steal. There are all sorts of views in terms of over the next 5 years, they'll be able to garner around $400 million, $500 million type of a sale of a $6 billion market, which is growing relatively slowly. So I think in that time frame, how many new players come up are key questions. But I believe net this is very positive for Sun Pharma.
Well, Darshan, Sameet had a call on Sun Pharma day before yesterday. I was reading his note to clients, and I think he made that comment on air as well the last time that we spoke. Sameet, So good call for somebody who's already into Sun Pharma. What about people who don't have any existing positions and with the likelihood that Sun Pharma will start in the positive day? What should an average trader do in Sun?
See, if it trades around say 510 to 515, then that also becomes a good trading opportunity. According to us, if we look at the Nifty Pharma index, it is trading around its important support levels now. So in our sense, Nifty Pharma is poised for a decent bounce back. Coincidentally, Sun Pharma is the one stock that is trading around its important support levels day before yesterday. 490, 485 seems to be a very strong base. And from here on, we would be expecting some kind of relief rally in this counter. So with a trading view, our target would be somewhere around 540. But if we have to take a slightly broader view, then we would expect Sun Pharma, heading towards 570, 580 as well. So as a trader, if it opens up somewhere around say 515 or 510, that becomes a good buying opportunity. 488 is the level to watch out for, so that can act as a very good support. One can keep a stop loss somewhere around that and expect immediate target 540 and then 570, 575.
Sameet, what about stock ideas? Let's get those out of the way. What are the two stocks that you're recommending today?
Coincidentally, Sun Pharma is the one stock that was there in my recommendation list. The other stock would be Jubilant Foodworks that you guys were discussing a while ago. So Jubilant Foodworks is the one stock that we have been liking since last 2 to 3 days, and if you look at yesterday's price action, that's quite encouraging, and the stock is clearly poised for retest its all-time highs. So one can buy at current level, keep a stop loss around 2134, and we would expect retesting of all-time highs, which is at 2330. And our solitary sell call would be on CSC. In last 3 days, we have already seen massive correction in the stock after breaching its important support levels of 920. If you look at the daily, weekly chart, the stock is clearly headed towards 860 now. So one can go short, keep a stop loss around 902. Our immediate target would be around 855.
And Kiran, what would your strategies be there for today?
Yeah, I've got 2 buy and 1 sell for today. NMDC will be my first pick. Strong delivery kind of volumes along with good open interest additions as we saw yesterday. 14% rise in open interest. That's the reason why I've got a buy on this counter. 118 would be my stop loss and a target of 125, which should be achieved today itself. Second would be NTPC again. Again, strong delivery-based volumes that we saw yesterday. And we should buy with a stop loss of 168.50, and the first target of 174 should be visible today itself. One sell call could be Repco Homes, where we saw a strong kind of sell-off in yesterday's trade, and the short position should be taken with a stop loss of 570 for a target of 540 for the day.
Okay, so those are some specific stock ideas. Now, Parthiv, taking our conversation back to something that we highlighted before, Tata Motors and Tata Motors DVR. Sure, the DVR is at a substantial compression of premiums compared to the Tata Motors main stock, and maybe the first port of call between the two should be the DVR. The question is this a good time to go out and take a bet or place a bet on the Tata Motors business?
See, Neeraj, I think I would admit that I was bullish on Tata Motors somewhere around 380, 400 levels also. And I think I was wrong. The only reason being I thought there's a lot of valuation conferred. But ever since then, I think the stock has underperformed. And the key reason being the main core business, which is JLR. No doubt they are making huge inroads in terms of the domestic business, whether we talk of the CV business, which is improving. And even this company did a lot of cost cutting in the bad days. And right now we are seeing a huge traction, whether we talk about the 20-year scrappage policy, etc. Even the passenger vehicle, thanks to Mr. Mahendra Parekh, who is the guy who did a lot of work at Maruti Suzuki. He is now handling the shows. He's also doing a good job in terms of knowing what customers want in the passenger vehicle segment. But the big question is, will this be enough to re-rate Tata Motors? Because bulk of the value for Tata Motors comes from the JLR business, and JLR business has been, I would say, struggling in terms of the numbers, and especially key markets like China, which were really the growth markets. So I think since a long time we haven't seen a revamped pipeline, and I believe that over the next 3 years they do have new launches in the foray, and I think especially their inroads in the electric vehicle market, even in the luxury space, can get a little exciting. So I think for Tata Motors, it's extremely important that the domestic market might do well, that's fine, but JLR needs to pick up in terms of the volume. And as on date, for the next at least 6 months, doesn't seem that there is any trigger that would revamp their JLR story. So especially they've even struggled in terms of the margins because of the cross-currency pressures, which was also not at all liked by the street. So I believe Tata Motors could time correct from here. I see very limited downside because of the huge valuation comfort. It's almost, I think, quoting at 9 times forward earnings. So I believe that if one has patience and has conviction in terms of the JLR story, then over the next 2 to 3 years, investing here at Tata Motors would reap, I think, very rich dividends. So I believe that yes, if one is patient investor 2-3 years, Tata Motors is the stock to bet on the auto stock.
Okay, Parthiv, just stay on the pre-open rates have started, so need to go across to the screen. Indicating a 0.5% uptick. It could anywhere be between 0.5% to 0.33% to maybe flat as well, because the SGX Nifty is completely flattened out in the lead up to the 9 a.m. clock, 9 a.m. tick. But for now, showing some upsides here. Let's pull up some specific names and see what they are doing. Banks should come up on your screen. Select banks were active in trade yesterday. There was also activity in Bharti Airtel and a couple of other stocks, so should try and pull up each of these. ICICI Bank, Axis Bank should come up on your screen as well. There is, I think, a media report.
Mint report that said that 2 of the executives at higher levels have tendered in their resignation. So,
yeah, so after the chief information technology officer, I think there's a couple of other high-level exits as well, much high-level exits. Let's see if the stock reacts duly. SBI is something that I'm interested in, and then Bharti Airtel as well as Reliance Industries. Bharti Airtel was fairly active yesterday, remember. For now though, very, very flat, so not showing anything. Actually the Nifty 50 showing a flat take, so don't believe there'll be too much of an activity within the Nifty 50 components as well. Maybe some newsmakers could be the movers.
Yeah, so Dilip Bilkon again, I think we get every day we get this note that they are lowest bidder or they got some project, but nevertheless closing in on the 1,000 level mark. Dilip Bilkon. NMDC has commissioned a coke oven battery at its upcoming steel plant, so that is important. Apart from it, there is Zensar Technologies that have done 2 acquisitions. So interesting to see whether Zensar has reacted positively or no. It's trading flat in trade. There is Omax Auto, which has a partial closure of its Manesar plant. That is important. Jildan Drilling has won an arbitration order of $9 million, so it's up 2% in trade, and GE Power has received orders worth 230 crores from NTPC, so that's also trading on the higher side. There are some block deals in which Hypnos Fund has bought in 1.5% stake in GHCL, so if we can pull up GHCL, it'll be interesting to see how that one will pan out in trade. It's up. Surprisingly, in the insider trade, Rajiv Jain of Bajaj Finance has sold in 60,000 shares. Obviously, he has a lot of shares, but he has been the seller, so Bajaj Finance continues to move in higher. So that's some of the counters. Tata Metallics, the big Elara note that has come out, so it'll be interesting to see whether Tata Metallics is reacting positively. No, it isn't. So that's what we're seeing right now, Neeraj.
I just want to mark RCom if we can. Yesterday the telcos, all of them, not just Bharti, but Idea and RCom were active too. Has Idea reacted? RCom, no, not quite so much. Idea should come up on your screen as well. So muted reactions really for most of these. Lastly, pull up the currency on the screen. Dollar reacted and lost quite a bit of sheen versus most global currencies, and duly the rupee too starting off actually marginally higher, not so much, 65.13. So in and around those 10-15 paise range that we've been used to now for the last 3 or 4 sessions. No big dramatic changes thereof. However, talking about what top brokerages are saying and the top brokerage calls for the day, Sameet Johnson with a list of those. Sameet.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Elara Capital on Tata Metallics. Now, the brokerage has initiated coverage on the stock with an accumulative rating and a target price of 838. Now, according to the brokerage, superior management and prudent capital allocation has led to a turnaround in the company and has made the company more cost efficient. Now, the company is in the process of setting up a PCI plan by financial year 2019, which will further aid the cost reduction and improve the profitability of the company. Now, the brokerage is expecting the company's revenue, EBITDA and net profit to grow at a compounded annual growth rate of 12%, 18% and 24% over FY17 to FY20. It is expecting the EBITDA margins to expand to 20% versus 17% in FY17, led by higher operating leverage and cost efficiencies. However, on the volume side, it is expecting that there would be a moderate volume growth because of the capacity constraints, and it is expecting the DI pipes and iron volumes to grow at a CAGR of 6% and 15%. Because of this capacity constraints, the brokerage is also expecting the company to announce soon an organic or an inorganic capital expenditure plans. Lastly, it says that given the significant improvement in profitability, they have assigned a higher valuation multiple to Tata Metallics. Second, we have is Deutsche Bank market research on IndianOpen Bank. Now, the brokerage has maintained its buy rating on the stock, but has raised the target price to 2,050 from 1,950. Now, according to the brokerage, the base business of the bank is doing well, and the merger with Bharat Financial will enhance its growth and profitability going forward. It also says that the business of the company will now become more diversified and profitable. It is expecting the return ratios of the bank to improve going forward. It is expecting the return on assets to reach to 2.2%, while return on equity to improve to 20%. It is expecting a steady net interest margin on current bank business, while the merger will enhance the net interest margin by 50 basis points. Lastly, it says that there are no current concerns about the asset quality and the microfinance business is in a sweet spot.
Okay, so Sameet, thanks. We'll watch out for that. Parthiv, any view on IndianOpen Bank? The merger with Bharat Financial will happen soon, but overall, what does IndianOpen Bank look?
See, I think IndianOpen Bank, every quarter when it reports the results, I think it gives an impression of a performance like what HDFC Bank does. I think they hardly tend to miss on any of the parameters, fantastic growth trajectory, and must give full credit to the management for taking this bank to this level. And these stocks in the private banking space will tend to stay a little expensive on the face of it. But I believe the growth that they're showing in terms of the capital adequacy that they have, and I think Mr. Uday Kotak very rightly mentioned that he's envisaging for the next 5 years the market share to shift from 70% of the PSU banks to 50% to the private sector banks and the NBFCs. So that's a huge shift. And in that case, banks like IndianOpen Bank will definitely capitalize on it. So I still believe that though it's expensive, but it's like the HDFC Bank of the world, which always tends to stay expensive, but over the next 3 to 4 years, it tends to give around 18-20% compounded returns. So I think IndianOpen Bank also fits that bill. And I believe that this shift from unorganized, which is the PSU market share, to the organized, which is the private sector market share, is a theme that can be played by stocks like IndianOpen Bank.
Okay, so those are a few key brokerage calls to watch out for. Amongst the newsmakers, I think IDFC, as we stated, could be one stock to watch out for. They decided to have off the AMC arm, and then a couple of other newsmakers include the telcos and the sugar names. Actually, Parthiv, how closely do you look at IDFC and IDFC Bank? The reason I ask this because a clutch of retail investors typically tend to buy into these names with the hope that at some point of time this will make big money. Somehow the stocks have failed to do that in the longest time in history. What would you be advising your key clients to do who either have IDFC or IDFC Bank shares or are thinking of buying them?
See, Neeraj, I think I believe that you're absolutely right. I think IDFC, the group which was one touted to be like the next HDFC type of a group, thanks to the pedigree of Mr. Deepak Parekh, I think has always failed to create any sort of shareholder value, whether we talk of post the demerger, and I think the results that they're showing is really extremely horrible in terms of what one can expect from such a private run franchisee. But I think a game-changing event that has happened for IDFC Bank has been Mr. Vaidyanathan. I think with Capital First and IDFC Bank merging together in the long run, I think that's going to be game changing. And the best part is that the new entity will be governed by Mr. Vaidyanathan. And we know for the fact that he is someone who knows how to create that value. So I think Capital First has done extremely well for its shareholders. And I think he was someone who was aspiring for a bank. And now with this merger, I think and with this ability to drive this business, I am far more confident as compared to the past management. So I think if one wants to play this theme, I still believe that either one can buy IDFC Bank or for that matter Capital First. And commenting on that IDFC AMC business, the source-based talk about the selling of their AMC arm, I think we also are distributors of mutual fund. And in fact, we have seen a trend that ever since Mr. Kenneth Andrade has left as the fund manager from IDFC, I think they've really struggled to garner higher market share. There's been a lot of employee attrition as well. So I think this move makes very good sense to sell out, and I think it's a good news for IDFC Limited shareholders.
Okay, some rates that have started trickling in. Sun Pharma is the top nifty gainer. It's up over 3%, led by Tata Motors, which is up 1.5%. Vedanta, Indian Oil, ONGC, GAIL. I think the gas stocks have started to move in today's trade, while Axis Bank continues to bleed. It's down close to 1%. So I think all these resignation news that are coming in probably will be an issue with Axis Bank going ahead. So we need to certainly watch out for them. Sameet, anything interesting? The pre-open rates have settled. Anything that looks interesting?
Okay, I have seized the one stock. Yes, it has corrected quite sharply. But 170 seems to be a multi-year support zone, so we would expect some kind of relief rally. So as a trader, as a momentum trader, one can go long. Risk to reward ratio is quite favorable. One can go long with a strict stop loss somewhere around 169.80, which is hardly 3.5 rupees from current level. And I would expect a decent relief rally towards 180 to 184. So one can go long, contra buy at current level for a target of say 180, 184.
Okay, minutes away from market open, and then we'll take in some questions with Kiran Jadhav as well. But first, let's tell you all that you need to know to stay ahead in trade today. Sun Pharma gets the FDA approval for Tildra, which will boost its specialty business, the stock starting off 3% higher.
Orders coming in. Dilip Buildcon emerges as the lowest bidder in an 870 crore project, while GE Power receives an order worth 230 crores from NTPC. It starts up higher by 1%.
Hypnos Fund buys 1.5% stake in GHCL via block deals.
Magma FinCorp, VST Tillers, Eris Life and Narayana Health will be meeting a lot of fund and investors today.
Jubilant Foodworks extends its everyday value offer to its range of regular sized pizzas, making brokerages upbeat on the stock.
And Elara Capital sees 14% upside in Tata Metallics, while Deutsche Bank raises Indusin target price to 2050 per share.
Kiran, a lot of people would be tuning in right now, wondering about what stocks to bet on, and we'll take in your top call in a bit. But just a word on Jubilant Foodworks. I know we spoke about it earlier, but a quick mention here. It's likely to start off about 0.5% to 0.75% higher. Would you initiate some fresh trades on Jubilant Foodworks at these rates?
Sorry, I couldn't hear you.
I'm asking you if you would initiate a fresh trade on Jubilant Foodworks. It's likely to start off about 0.75% in the green.
Yeah, as I said earlier, Jubilant Food looks good on the charts, and positive view has been maintained by us as well. So with a small gap of opening, we believe that it will lead to further upside. My stop loss for extreme short term would be 21.75, and we'll have a target of 22.60, 22.70 for the day.
Interesting. So that's the call on Jubilant Foodworks. Sun Pharma is starting off, as Darshan said, as the best performing stock on the index as well. Sameet, would you go out and initiate a fresh position on Sun Pharma?
See, as I said, as a medium-term trader, yes, I would certainly go long.
After a 3% uptick.
Yes, as I said, as a medium-term trader, my target would be around 570, 575, and I'm looking at important support level around 490. So that makes a good risk-reward. But as a momentum trader, I would rather wait. As I said, 510, 515 becomes a very good risk-reward for me. So if it cools off a bit from current level and enters this important support zone 510, 515, then probably I'll go long.
Some of the government owned stocks are doing well. ITI is up 6%. RCF is up 5%. MTNL has managed to move up. National Fertilizer and a couple of these PSU banks like Corporation, Allahabad Bank, IDBI Bank, all of them are moving up in trade. So the move isn't very steep, but nevertheless it's a positive view. TV Today, after rallying significantly, corrects by 2.5%. DB Realty is down, Oberoi Realty is down. But some of the PSU banking stocks like Bank of India, United Bank are also trading slightly weak. But minute and a half left for open. Neeraj, can you spot anything?
No, I think you pretty much summed up all the activity on the gaining side for sure. And on the losing side, TV Today, which was a top gainer yesterday, is likely to start off about maybe a couple of percentage points lower in trade. So maybe a good time, Darshan, to get in the top trading call from our experts. Kiran, do you first. Your top call for the day, if you had to bet on one stock for the day today.
See, Aban Offshore would be one counter that one should be looking for with the kind of rally that we saw in crude yesterday. Aban is one counter which we believe that should perform on the day. So we have a buy call on Aban with a stop loss of 160, which is very close to yesterday's close. And we'll have a target of 167 for the day. So 167, 168 is a crucial level for this counter. If it manages to move above this, it will start making a first higher top, higher bottom, and a price trend reversal price pattern, which can then take the stock to 180, 190 kind of levels.
Sameet, what about you? Your top call for the day?
Jubilant Food target remains at 2330. Overall chart structure is quite strong. Any minor dip would be a good buying opportunity. Keep a stop loss at 2134.
That seems to be a consensus, Jubilant Foodworks. Sameet, Chavan as well as Kiran, Jadhav. Gentlemen, many thanks for joining in today and giving us your perspectives. This is how we are likely to start off today's session flat. I think the Nifty Bank too in the pre-open rates was very flat, and no surprise it's really started off on a flattish note. So no big moves on the Indian markets. The Asian markets were trading fairly positively. I think they too cooled off a little bit from those highs, and the SGX Nifty showed that sign. So not surprised that we've started off on a flat note in the session today. What about the mid caps and the small caps? About 0.25%. So again, fairly flattish moves. Don't think that will be too much of a heightened activity on the Nifty 50 either. Maybe even Stevens. Yeah, almost even Stevens really for the gainers and the losers. Bharti Airtel, which was a big more in trade yesterday, is starting off on a negative note, so about 1% lower. There is some bit of weakness in SBI, so that could be an Axis Bank. Well, has not reacted too much, just about 0.5% really to this news reports that have come out in the mint. So not too much of a dramatic reaction. Sun Pharma, 2%. Again, I presume that it's not a dramatic reaction. 2.25%, so just about starting okay. Tata Motors mildly in the green. Bharti Infratel has had these sporadic moves a day, every alternate day. In today's session, starting off about 1%. So no big moves really. Just the flavor is even Stevens. Just 2 or 3 names that I want to highlight before I throw it to Darshan for what the liquid universe could be doing. Some newsmakers and some market movers. Cheaper pizzas. Jubilant Foodworks starts off about 1% higher, so that stock becomes more expensive with the pizzas getting a bit cheaper. That one started off well. Order wins coming in for Dilip Buildcon yet again and nudging the 1,000 mark now, 2% higher for Dilip Buildcon in the session today. Last but not the least, a clutch of movers from yesterday's session. TV today starting off 3% or 4% lower now. On Arcom and Radico Khaitan, 2 top movers yesterday starting off in the green. Darshan, what are you spotting?
So future market is up 10% again, so there is significant traction. Goldstone Infra from the smaller companies is up almost 6%. Last I saw India Bulls Ventures surging in trade, but if we can pull that up, India Bulls Ventures, so that's cooled off significantly. Madras Fertilizer, Nagarjuna Fertilizer, RCF. Today the fertilizer pack seems to be doing well. That is the trend that I am seeing. There is ITI, which is up in trade. JBF Industries, after so many days of fall, is up in today's trade. What is not doing well? Alembic is down 8%. I don't know the news, but it's showing me a downtick of 8%. I don't know whether any dividend or something is there, but it's down in trade. TV today is down almost 5%. Some of the metal stocks, Sandur Manganese is down in trade, so that's broadly what I am seeing at this point of time. DB Realty is down 2%. Crompton Greaves Consumer is trading down 2%. So I think that's the broad. I don't think there are any fireworks anywhere in any of the stocks as such in today's trade, Neeraj.
Yeah, you summed it up very perfectly, Darshan. So that's essentially the mood of the market. Parthiv, before we let you go, any thoughts on this future market lifestyle or future market retail stock? It's been having some very strong moves very recently.
Yes, Neeraj, I think in terms of the valuations, I think I've seen this group buzzing, especially after the Avenue Supermart IPO. And probably the market is envisaging that post the GST era, I think these guys are going to have a lot of benefit. But one problem that I have with this group is, I think God knows how many number of companies they tend to demerge, again get listed. So all this tends to get very confusing in terms of which companies focus today. And there's a lot of inter-company related business going on. And still, I think in terms of the performance that one would seek after such a run-up and after such a re-rating, is not been coming in terms of the numbers. So I think I would be waiting patiently, wait for the numbers to come out and then decide the future course of action. So no new investment in this group at this juncture.
Okay, the Nifty slipped into the red at this point of time, so the traction is certainly on the downside. But Harsha Upadhyaya, Chief Investment Officer for Equity at Kotak Mahindra Asset Management Company, joins us on the show. Good morning, Harsha. Firstly, what's your view on the trade market setup?
Good morning.
Good morning. Are you seeing any kind of worry because the market seems to be a little nervous? Overall, what's your view on the trade setup currently?
We believe that in the immediate short-term market is in a consolidation phase. We have seen very less volatility in the entire calendar year of 2017. We are of the opinion that volatility is going to increase in 2018, and also the return expectations have to be more moderate than 2017 for this year, for the next 12 months. So with that in mind, we believe the immediate short term could be a consolidation phase. Nothing to worry from a long-term investor perspective, but if somebody is unable to take this volatility, obviously there is a problem. Last year, everyone felt that equities are one-way street where volatility is less and you can make money entering at any level. And that couldn't have lasted longer. And now we are in a phase of consolidation, clearly.
Harsha, good morning. Neeraj here. When we talk about the extreme short term, would it be dependent on the results? And are you talking about the next 1 or 2 months, or could the volatility persist for slightly longer than that, maybe a couple of quarters?
A couple of months definitely until the earnings season. I think that will give us some sort of an indication, although I won't say that it will give full indication in terms of how next year is going to pan out, because there are many ifs and buts that are going to be there post June quarter, because until June quarter we have a lower base that was there because of demonetization and GST transition last year. That's going to go away, and then post that we are going to see some of the provisioning numbers increasing on the corporate lenders in the banking space. So clearly FY19 earnings numbers, you won't get any confidence by looking at let's say March quarter numbers this year or June quarter numbers next year. So to that extent, earnings alone will not really help the markets. But yes, I think as we move into the second half, the news flow would be more from a political setup. I think that's what is going to drive the sentiments then. But until then, I think it's going to be the earnings trajectory that will drive the markets.
How would Q4 shape up, Harsha? I mean, one is, the commentary in the last few weeks has shifted to what kind of an impact would distraught banking sector have on Q4 earnings. We did a bit of a study as to what this PSU bank washout or the recent cuts in the earnings for some of these corporate facing banks come PSU banks could do to the Nifty EPS. It didn't seem to be too much based on at least what the Bloomberg terminal is throwing up. Are you bracing yourself for some unpleasant news on the earnings front because of banking? Or do you think it will be muted, but there's just too much of conversation happening around it?
See, it's at this point of time very, very difficult to predict the kind of provisioning that will be required in the fourth quarter. There could be some upfronting that some of the banks would do since they know that 6 months down the line anyways more of this has to happen. There may be some delays also in some cases. So we really don't know how some of these earnings numbers will pan out for the PSU banking space especially. So apart from that, I think rest of the market, we don't think there will be too many disappointments. The disappointing sectors are known. For example, telecom is going to disappoint in terms of earnings. Pharma is going to disappoint. PSU banks. So these are the pockets where we have no clarity in terms of how much will be that drag on the overall earnings. But rest of the markets, we are fairly confident that will grow at mid-teens. So overall numbers would depend largely in terms of how this drag is going to pan out. If the drag is more than what everyone is expecting, then we are going to have very muted set of numbers. Otherwise, I think it will be somewhat similar to the previous 2 quarters.
Harsha, what's your view on metals? Overall, metals have corrected significantly globally. How does this sector pan out now?
See, we were of the opinion that the valuations had run up much ahead of fundamentals in the entire 2017 for metals pack. Now that has corrected quite significantly. And also global growth seems to be catching momentum, and there are positive expectations in terms of how the global growth is going to pan out over the next 12 months, 24 months. So given that, we think that at these valuations there is some merit in looking at metals companies, but one will have to be stock specific, looking at what could be the possible impact in terms of the likely tariff wars that are going to come out, and also in terms of how that is going to displace some of the regional capacities and supplies. That is what we need to see and take stock specific investment opportunities.
What about the oil companies? Crude again back at $70. How will that play out for the oil marketing companies?
We continue to hold some OMCs in our portfolios. As of now, there has been market determined pricing. There has been no interference in terms of not adjusting the prices to market reality. So as long as that continues, I think even if the crude were to move up to higher levels, the profitability will be maintained, and we won't be really worried about that segment as of now. But in case there is a change in any of the mechanism in terms of adjusting the prices on a regular basis happens, then we'll have to wait and see how that is going to impact profitability. But in the last 4 years or so, we haven't really seen that kind of an impact. But as we are getting into an election year, some things could change. That is what we need to see. Other than that, I think oil marketing companies continue to be attractive on the valuation basis.
Okay, just hold on, Harsha. Let's pull up Hindustan Construction Company. That's down almost 4% and close to 20% fall in the recent times. And a DNA article that's come out has indicated that Lavasa, which is owned by HCC, is headed for bankruptcy and probably will approach the NCLT. So I think they don't have money to even finish the project. So Neeraj, another one goes down.
Yeah, and this was the only shot in the arm for HCC, right? I mean, they had gotten that arbitration awards and all of that was anyways done, but they still needed this to work for them to come out of the woods. Somehow, this is not good news for HCC at all.
It isn't.
Yeah, well, let's wait and watch. Could have some impact, further impact though. As Darshan said, if you just look at the 1 month chart, you will see that HCC has, unless I'm very wrong, come off quite a bit from those levels as well. Maybe the recent corrections are the tune of 15-20%, yeah, 70% over the last 1 month. So some of it was being priced in as well. I mean, things come out, and let's wait and watch if indeed there is an approach done to NCLT as well. That whole process, Harsha, is becoming fairly interesting. It's difficult to predict who the winners of this would be, because I think it will eventually depend upon a Supreme Court decision as to who gets awarded what. But how does this augur for what happens to the metal space after some of these assets which were operational but not operating at full capacity come into stronger hands, and then there is by natural augmentation an increase in capacity that comes in for India's steel sector? What does it do to this space which was clearly the biggest or one of the biggest outperformers over the last 12 to 18 odd months?
See, as far as some of these capacities which are under NCLT today, they are running simply because they need more cash flows to service their interest burden. So to that extent, I think they are not looking at earning anything over and above debt servicing. And once the resolution happens, I think there will be more economic sense that will prevail. That's what our belief is. And hence, you will not see too much of readjustments in terms of demand supply, but from a pricing perspective, I think it will be a lot more sensible is what we believe. And if that were to pan out, I think there is no risk for any of the metal stocks per se. But as you feared, if the buyer starts to ramp it up in terms of more capacity additions or sweating it out much more than what they were doing earlier, then obviously that could have an impact on prices in the short term.
But you don't believe that hypothetically, if an ArcelorMittal, though they've been out of bid now, but if an ArcelorMittal were to come in, or JSW picks up SR, Tata Steel gets a Bhushan, and they start operating these capacities at a much higher capacity utilization levels, wouldn't that increase the supply and therefore a bit of a compromise on prices over the medium term? That's not a worry?
Without getting into individual cases and individual companies, I think whoever is going to be a part of this entire process, they are already present in those sectors in the country or in the region. So to that extent, anyways, they have an vested interest to keep everything at a balance. I don't think there will be indiscriminate ramp up of capacities and prices coming down. We don't visualize that at all.
Okay, Harsha, yesterday, or rather this morning, we did a small study of, despite the market fall, companies which will be trading at premiums to their 5-year average valuation multiples, PE, price to adjusted book or thereabouts. There's a fair bit of Nifty presence which is still trading at premiums and a substantial premiums to their long-term averages as well. Is that something that could concern people as well, or investors as well? Does it concern you as well that we have had a fall, but there is room for a bunch of these companies to fall too, if need be, without being considered cheap?
Yes, that is possible, because when you look at overall valuations of Nifty today, they're about 10 to 15% higher than the long-term averages. So to that extent, there are pockets within Nifty as well, apart from mid caps and small caps, which anyways have been very, very expensive relative to large caps. But even within the large cap space, there are companies and sectors which may have been trading at higher valuations than in the past. So those are the spaces where you need to be more watchful. If earnings start to disappoint in some of those pockets, I think there is room for further fall. But at this point of time, some of these names are some of the pockets where earnings growth seems to be better than the rest of the market. So to that extent, there is no fear of correction in these names. But we'll have to wait and see in terms of how earnings are going to pan out.
Yeah, okay. So, Harsha, with an assumption that, actually, let me ask you that question first. How was March? A lot of people were talking about, in fact, some of your peers came in and said that in certain dividend-paying schemes, they have booked profits or booked some money in order to pay off the dividends as well. In certain cases, it's been high, but nothing quite unnatural. But my question to you is, how was March for Kotak KMC in terms of, one, the fund flows, and two, whether you did book profits into certain schemes if you needed to, or if you thought the valuations were expensive, and where is it that you're deploying fresh money or putting fresh money to work?
See, profit booking is a regular process for us. We don't wait for any event or any quarter end or year end to book our profits. So that's a normal ongoing exercise. And when we believe that relatively a particular stock is expensive and we need to book profits, we book profits and move into other stocks. And clearly over the last couple of months, we haven't added new names into our portfolio. Wherever we have been a little worried in terms of valuations from those stocks, we have booked profits and got into something we were already holding and which have fallen without any change in fundamentals. So that's been broadly our stance, not adding new names, not adding more risk to the portfolio. As far as the fund flow is concerned, we haven't seen much of a difference in terms of the trend that we were seeing even before March. I think the real sense of flows will come only in the month of April and thereon, because this month, as you rightly pointed out, there are dividend declarations. There will be some profit booking or selling because of taxation change, etc. So we really don't know whether to take March numbers as a barometer for what's going to happen over the next 12 months or so. Having said that, I would also like to add that we haven't seen any impact on any kind of flows in the SIP market. That number is more than $1 billion a month. Even EPFO flows into ETF should continue at current levels. So large part of the flows that we have been seeing over the last 1 year will remain intact irrespective of market valuations, is what we think. But the exact sense in terms of how the numbers are going to pan out, I think April onwards we'll get a fair idea.
What about, Harsha, if you can humor me, What about the discretionary side of the flows coming in? SIPs, I'm happy, really happy, and that's the effort that that we have on the mutual fund show as well, is order to get people to stick to their investments during the bad times, because that's when you will make money. But what about the lump sum flows? Are they in these months of February and March, wherein we've seen the first signs of real volatility coming in, have they changed a bit?
Yeah, in the month of February, we saw some moderation, but I really don't know whether it's the beginning of a new trend in terms of lump sum investments. The net retention in the industry was lower compared to previous few months. But we also had 3 less working days in the month of February, so that itself is a 10% fall. So I really don't know whether to take that as an indication in terms of how things are going to pan out going forward. March again, as we discussed, it's not a normal month because there are inflows and outflows due to some of the dividend declarations that have been there in the industry. I think, I'll again repeat that we will get a fair sense of discretionary flows only from April onwards.
Okay. One last question, Harsha. One side of the market discussion would be to think of where do people put in money, where do investors or where do fund managers like you park your money. The second part is, where is it that you completely avoiding any kind of investments based on the news that we have and the valuation picture that we have at hand. What do you want to talk about that?
As I said, we are focusing more in terms of visibility of earnings growth going forward. So there are pockets where we can't be really confident in terms of future earnings trajectory. So those are the names or the sectors where we have been very, very circumspect or have been avoiding the spaces. For example, we hardly have any weight in telecom sector. On the PSU banking segment, we hardly have any weight. So these are the pockets which we believe are going to be under pressure in terms of profitability. Pharma again is another segment where I think a lot of the fortunes of the sector is dependent on US FDA approvals, where you can't really predict either the timing or the outcome of those approvals. So again, we are not in the camp to take any blind bets in that segment. So these are some of the pockets where we are avoiding. Apart from this, we are also a little cautious on the NBFC sector, where we believe we have seen significant growth in the business in the past, and interest rates were very, very conducive for wholesale borrowers. And as we move forward, I think there is going to be pressure in terms of cost of funds, and also with the kind of growth that we have seen in the recent past, there could be asset quality issues coming up in the NBFC sector as well at some point of time in the future. As of now, there is no risk, but I think given the kind of growth that we have seen in the past, one needs to be a little cautious, especially at these valuations where some of them have been trading even higher than some of the private sector retail banks. So these are the spaces where we have been cautious. Otherwise, by and large, we continue to hold the same view on the markets, that there is economic recovery which is visible. Although the pace could have been higher than what we have witnessed, but at least it's visible. And there is a large amount of excess capacity in the country. And the operating leverage of this is going to pan out over the next 12 to 24 months. And that's what will provide profitability boost for Indian corporates. And those are the bets that we are taking in our portfolios as well.
Great. Your set of investors will be reassured, Harsha. Thanks so much for taking the time out and joining us today. And well, all the best with the investing.
Thank you.
That's Harsha Upadhyaya of Kotak KMAMC. Well, the markets as we speak have gained some ground, I must say, and sans banks really haven't done anything, but the Nifty 50 is up 0.5%. Look at the Nifty Bank, it's lying absolutely dormant in trade, so no moves out there. What's leading the charge? ONGC 3.5% higher, Sun Pharma a couple of percentage points, but that's on news, on expected lines. But upstream seems to be the thing. Reliance Industries too, about 1.25% higher, so good going there. GAIL is looking okay, about 1% higher. So oil and gas certainly moving up in the session today. Select IT seems to be doing okay. HCL Tech, for example, is marginally in the green. So I guess a mix of pharma, oil and gas, and we select IT. is what is leading the markets to do what they are doing. UPL and Z2 amongst other stocks which are doing well. Might we pull up the mid cap and the small cap indices just for a moment and see what's happening there, because while the large caps are doing what they are doing, the mid caps and the small caps too have bounced back a little bit from the levels that they were at. So not bad. This is actually quite a different start than what we've been used to in the recent past, which is a sell after a start which is in the green. So this is heartening. Let's see if this lasts or no. Up next, though, we'll talk about whether the buoyancy in the graphite electrode business will last or no. The CFO of HEG, Mr. Raju Rustogi, would be joining us on the other side.
Nine to 5 job, अरे 5 to 9 job, भाग दौड़ all the time job. The roaming वाला job, the deadline वाला job, or are you living in the market वाला job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution hai. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
A show and a series where we speak to some of the best investing minds in the Indian markets and try and figure out how is it that they generate alpha for their investors. And in the case of today's guest, needs no introduction, Mr. Vijay Kedia joins in right now on the show.
Only one mantra in stock market is to make money in market is to sit for long term only. You cannot make money unless you have patience to hold for your stock for 10 years or 15 years or 20 years. You certainly cannot make money in stock market. Majority of my portfolio, if you that would be not more than 10 shares. To get a cleaner management and a management with a good track record, so I have to find only 10 shares.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. The markets seem to be doing okay. 0.5% higher for the Nifty and the Sensex. The Nifty Bank is not participating, as we discussed just before the break. Now, the reason for calling the next management is this long-standing, or rather, the reason for the last 6 months, which is the shutdown of induction furnace capacity in China, which has led to a revival in demands of graphite electrodes, at least over the last 6 months. The question mark would always be as to how long can this demand revival last, and what could the resurgent demand do to the financials of some of these companies, HEG and Graphite India in particular. Joining us to talk about this demand and the tight supply situation is Raju Rustogi, the Chief Financial Officer of HEG. Mr. Rustogi, good having you. Thank you so much for joining in. You know, when we last spoke to Mr. Ravi Jhunjhunwala post the quarterly numbers, if I'm not wrong, which was somewhere around early February or mid-February, he had mentioned that the picture as of now looks fairly okay. What happened in Q3, which was an uptick in pricing, seems like continuing in Q4 as well. We are almost at the end of the quarter. How is this quarter shaped up, Mr. Rustogi?
See, the message that was shared by our chairman exactly is the situation of
Mr. Raju Rustogi. Mr. Rustogi, would you care to just give a reply again? We'll just try and see if the line is clear.
See, the message that was conveyed in the third quarter.
No, I think there is some audio glitch. Mr. Rustogi, we'll just try and refix that line in just moments from now. Just let's wait and watch and just try and repatch that line and the audio properly before we get the comments coming in from Mr. Raju Rustogi. Just take a look at the markets for the meantime, because they deserve to be looked at. Remember, as I said, the last few days we've been used to the template of the markets starting higher and then falling off. Today seems to be a slightly different picture. Aban Offshore, I think it was a recommendation from Kiran Jadhav today in early morning trade as a stop call, and that stock is up about 3.5% higher. So must say though, it started off higher and it continues with where it left off yesterday. I think Shipping Corporation of India, Aban Offshore and a few of these companies had a fabulous move in trade yesterday. And I think they're starting off well in today's session too. That aside, there is some traction that we're seeing in stocks like RCF, MTNL, ITI, so seems to the PSUs are doing okay in trade. Cyient has some bit of an upside. Shoppers Stop has some bit of an upside. So there are a couple of these names which seem to be doing okay for themselves. Vakrangi at 2.5% is at 292, so that's not done too badly for itself. It's just difficult to predict what this one will do next. And what about some of the larger names? They include, as I said, an ONGC. And TRACOM has some traction for sure. 2.5% up today after a 13% up move yesterday. So good moves that have come in to all of these. Okay, let me retry my luck with Mr. Raju Rustogi. Mr. Rustogi, can you hear me?
Yes, I can hear you.
Okay, do we have the line clear? No, we don't have the line clear, unfortunately. We'll just try and get that going. It's important to have this discussion with Mr. Raju Rustogi. There are a couple of points as a result of which I want to do this. One, remember in the month of October, when this whole conversation with HEG started, and the Jeffries note, which led to almost everybody turning bullish on HEG, there were 2 points that had to be monitored. One is whether HEG would be able to renegotiate some of the old contracts to spot prices for FY19 or no. They had managed to do that in FY18. Whether they will be able to do that for FY19 or no, that was one key question, and I think I want to ask Mr. Raju Rustogi about that. Two, about needle coke. Remember, the global needle coke production was diverted to lithium-ion batteries, which was getting them a better bang for the buck, and that would have led to some bit of, I mean, needle coke is a raw material for companies like HEG, and if that was being diverted and there would not be enough needle coke coming in to companies such as HEG or Graphite India, then that would have meant that the utilization levels for companies would come off a bit. Now the question mark again would be that while FY18 was known and there was a mild impact, whether there could have been more in store, that's the question. You know what, I think we should try and get Mr. Raju Rustogi on the phone line. I'm told, in fact, we have him, and the audio should be clear there. Mr. Rustogi, can you hear me now?
Yes, I can hear you.
Okay, and I can hear you clearly too, so that makes two of us, and I'm very glad to know that. Okay, let's talk about first the pricing scenario. As I said, the last time Mr. Ravi Jhunjhunwala was with us, he said that volumes may not have picked up materially, but pricing was looking extremely buoyant. As we head to the end of the quarter, how would you give us a sense of how the quarter at large has shaped up on the pricing front?
See, what Chairman conveyed at the end of third quarter, that situation continues and the prices are still on the higher side, and we are able to realize the market prices as on today.
Okay, so pricing, you're saying that the pricing trends that we saw in quarter 3 would continue to have continued into quarter 4 as well?
Yes, it is true.
Okay. A couple of things, Mr. Rustogi, that I think people wanted to know about. One is on the contracts. Now, I believe you were able to renegotiate some of your old contracts way back in October or November to spot prices then. And I believe the analyst community was working with an assumption that for FY18 it was a done deal. But for FY19, would that happen or no? Because you were planning to get into yearly contracts for electrode volumes as well, but quarterly on pricing. I'm guessing those negotiations would have happened already. Can you share some light here?
Yes, the contracts for year 18-19 are underway. But the only thing is, the change is we are no more doing annual contracting. We are now doing something like quarterly or at the most 6-monthly contracts. So contracts for the first quarter have already concluded and the prices are looking favorable for us.
I'm guessing, Mr. Rustogi, that you as a company would do that if you believe that prices would stay at the current levels, at these elevated levels, or probably improve, because only then would it make sense for you to enter into quarterly contracts. Is the assumption, inherent assumption, that graphite electrode prices would stay stable or increase during the course of FY19?
See, why we are doing quarterly contracting from the erstwhile practice of annual contracting is the market itself on the raw material supply side, the contracting has changed. It used to be annual contracting. That contract pricing has changed to quarterly contracting. So we want to secure our margins by, doing the sales side contract as well on a corresponding quarter basis.
Okay. Having said that, I'm guessing you would inherently also believe that prices would at least stay stable, right? Otherwise, you might as well lock the prices for the year?
See, I can only foresee that the prices have improved from what level they were till the previous year, which is financial year 18. So keeping that in mind, and also the raw material constraint where we are contracting for quarter, we want to contract for a quarter, and we see the prices not coming down from the present level.
Present levels would be what, $6,000 per ton, Mr. Rustogi?
See, the specifics cannot be shared, but I can only say that, yes, these numbers or even higher than these numbers is what we are seeing today.
Well, which is actually pretty good. I'm happy for you, Mr. Rustogi. The other question and other point that most people were also wondering about back then was the global needle coke. The production, I believe Mr. Jhunjhunwala also mentioned, that was being diverted to lithium-ion batteries as well. And you had semi-annual contracts for the raw material till March. How is that picture shaping up for FY19?
See, for needle coke, we have the volume contract or the quantity contract for the entire year, which is calendar year 18 in place. But with the vendors, the pricing is being settled on a quarterly basis.
Okay. So would there be an impact on utilization due to needle coke availability for FY19, Mr. Rustogi?
Yes, we see an increase in utilization from the present level of 80%. We believe that with the present level of contracting and volumes that we are committed with the suppliers of needle coke, the capacity utilization may go up around 90% this year.
That's music to the ears. And that's a bit of a deviation, isn't it, Mr. Rustogi? I mean, the assumptions of the analyst community, rightly or wrongly otherwise, is a separate thing. But was that due to needle coke issues, the capacity utilization levels for you, maybe in Graphite India, would come down? Here you're saying that the capacity utilization in FY19 will move up from where it was in FY18.
So this is based on the situation that we are seeing as on today, and we at least are sure about at least the coming 2 quarters. And we believe with the volumes that we have committed with the vendors, we should be higher than at least calendar year 17.
So all of this...
So calendar year 17 has been 82%, and we should be at least 85% in the coming year.
So all of this leads me to believe, Mr. Rustogi, that the earnings traction that a company like yours had started showing in the last 2 quarters of calendar year 17 would only accelerate at least in the first couple of quarters of calendar year 18, if not longer.
I think we only see that the market is favorable to us. Acceleration of these terms are relative, and we would not like to comment on acceleration, but yes, maintaining or improving on the current margin is what we can foresee for at least the coming 2 quarters.
Well, and we wish you all the best for that and longer, Mr. Rustogi. Thank you so much for taking the time out. We look forward to talking to you post your quarterly numbers as well.
Thank you.
All right, that's Mr. Raju Rustogi, the Chief Financial Officer of HEG, with his thoughts on what's happening. Remember, Vanguard parked itself into HEG very, very recently. That's a large investment that they made. It raises eyebrows, and therefore it was pertinent to figure out if indeed the business momentum was looking strong. If anything, the conversation seemed to suggest that it's only looking stronger than what it was maybe in the last 2 quarters of calendar year 17. Okay, before we end Indian Open, let's address something that's taken social media and the entire political establishment by storm. Facebook, at least world over and in the US for sure. Facebook CEO Mark Zuckerberg has finally broken his silence on the Cambridge Analytica data breach issue. The founder of the world's most popular social networking site, which was hacked by the data analytics firm, has accepted responsibility and promised to put in enough safeguards to block further breaches. He says, and I quote, "We have a responsibility to protect your data, and if we can't, then we don't deserve to serve you." He also went on to add that other applications will now have very restricted data access to Facebook's domain to prevent any other kind of abuse. Zuckerberg's post comes 2 days after The Observer and The Guardian put out detailed reports on how the Cambridge Analytica used data from Facebook and other social media sites to influence the US presidential and Brexit elections. Back home, Indian politicians are also trying to accuse their rivals of hiring Cambridge Analytica, but nothing's been proven yet. So what's Cambridge Analytica, and how did they go about using the data to influence voters? Here's a small explainer.